Well, as credit union strategic planning teams go into their planning sessions, they should be in a recovery mindset, a recession recovery mindset. This started taking place last year and is really gaining traction this year. So since '08, credit unions have been cutting costs, becoming more efficient, and those are all good things. But now strategic planning teams need to start thinking about growth and setting ambitious goals for growth for the next couple of years. And we're already seeing, in response to our surveys, credit unions increasing their technology budgets to go after some of that growth. And one of the ways they're increasing spending is in mobile banking and online banking. They're investing in remote deposit capture, all the remote delivery channels that members are expecting. Those are the ways credit unions are investing their technology budgets right now. And I think about 30% of credit unions have increased their technology budgets by more than 10% over last year. So this just reflects a recovery mindset among many credit unions as they invest in the remote services that members are expecting. Credit unions are also trying to understand the payment systems model right now. It's very complex and it's difficult to understand, but there are disruptive technologies possibly on the horizon that could jeopardize the payment systems model as we know it, and that would put at risk credit unions' interchange income. So credit unions need to be talking about what would we do if a disruptive technology came along and cut our interchange income in half, or something along those lines. That would be very disruptive for credit unions, and they need to be thinking about a plan B as to what they would do if they lost that valuable source of non-interest income. There are some pretty optimistic projections right now for loan growth over the next couple of years. CUNA's economists are projecting 7.5% loan growth for this year, 2014, and 8% loan growth for 2015. And those are some of the best projections we've seen since 2007, since just before the recession. So with credit union loan-to-share ratios hovering around 70%, there's a lot of pressure on loan departments right now to lend out that excess money and to increase that loan-to-share ratio up into the mid-70s or even closer to 80% if they can, is to get those dollars loaned out. So credit unions are under pressure to make more loans, but they need to be careful not to just make more loans for the sake of making more loans. They need to make good loans, and they don't need to chase rates, because that's a race to zero, and nobody really wins in that type of a race. So making good loans and making good investments with their technology budgets, those will be some of the things you're seeing credit unions talking about in their strategic planning sessions. Well, they're going to have to gear up for the loss of refi activity in the mortgage market. Most of the mortgage activity will be taking place in the purchase money market, so credit unions will have to adjust their loan departments and their mortgage personnel accordingly. We're seeing low awareness levels of credit unions among non-members. So as credit union strategic planning teams start to set goals, they should think about increasing the level of awareness within their field of membership among non-members, especially among young members. That's a very troubling number right now in terms of young non-members. About 70% of non-members between the age of 18 and 25 know very little about credit unions. So that is not a good omen for future membership growth. So credit unions need to do what they can through social media and other channels to increase the level of awareness among non-members. And there's also a very low share of wallet that credit unions have. That could be another goal that planning teams should consider is increasing the share of wallet among their members. Credit union members have very low percentages of their loans at credit unions. Most of their loans are at banks. And with new car loans, used car loans, credit cards, mortgages, they're all below 15, maybe as low as 2% in some of these loan products. So increasing that share of wallet among the members that credit unions already have will be vital for the growth in the future. And another positive trend that we're seeing is a let-up in the regulatory burden over the next 2 years. As this recovery takes place, Congress is less likely to pass laws that would result in an increased regulatory burden on credit unions. They're less likely to pass those laws during an economic recovery because they don't want to get in the way of an economic recovery. So they're less likely to load up financial institutions with rules and regulations.